This is a video on the Polaris Valuation spreadsheet. It's brought to you by PolarisInvesting.com, a site for creating defensible valuations. Recall, business valuation is based on expectations derived from skillful consideration of past facts and future possibilities. This video can be watched from the spreadsheet itself from a link in the About worksheet titled About Video. In this video, we'll be talking about three things. One is, why was the spreadsheet developed? 2, how do you get it? And 3, navigating or using the spreadsheet, which we will be spending the majority of the video on. So why was the spreadsheet developed? Well, to answer that, we're going to go take a look at the PolarisInvesting.com site. You see it has 3 sliders for the user to change the values for sales growth, future profit margin, and future price earnings multiple. Other information that's used in calculating valuations are shown at the bottom, namely the competitive advantage period, the shares growth, the cost of equity, dividend, current sales, and shares. These values cannot be modified. So from the website, again, the only 3 values that the user can change are here at the top. Well, this is sufficient the majority of the time, but for some advanced users, they want the flexibility to change other values that go into the valuation formula and to have a more thorough understanding of the Polaris valuation formula. So think of the Polaris valuation spreadsheet as a companion spreadsheet to the Polaris Investing website. Next, we're going to discuss how you get the spreadsheet. You go out to the PolarisInvesting.com site. You can take the link here, Dropbox links, or if you scroll down on the welcome page, there's a download. Either way, it'll take you to the same Dropbox location. And then you click on the app valuation folder. And then if you click on the spreadsheet, you'll see the Dropbox worksheet, which is the same as in this current open spreadsheet, namely this Dropbox worksheet, and it gives you specific instructions of how to download it. Okay, let's now discuss how to use the spreadsheet. First off, you'll notice here at the bottom of the spreadsheet identifies the different worksheets that make up the spreadsheet. So let's quickly go through those. Here on the very right is a Manage worksheet. It has primarily 2 values. By the way, the convention in this spreadsheet is that any cell with a gray background is for user input. So there's 2 main configuration values here that influence the way that the certain functionality of the spreadsheet works. But most times you won't need to do anything on this site or worksheet, so it's recommended you go ahead and hide it. Next one here is called the TrustIt. It is recommended when you first start, you look at and read this TrustIt. Make sure that your Excel environment through the file options is set up as recommended here so that the spreadsheet works properly. But once you're done with that, you can hide this as well. 3 new worksheets have recently been added: topical candidates and queries. Suggested they be hidden when not in use. The topical worksheet lists stocks that you may find of interest. This list is frequently updated when a new version of the spreadsheet is released. The primary purpose of the candidates worksheet is to run the candidates query that results in tickers that could be further explored on the valuation worksheet. The query shown is selected from the drop-down menu. Other queries are available. These queries reside on the queries worksheet, of which you can add additional queries. You can also change the queries once they're selected and brought into this cell A2. So if I want to only see companies that have sales of 20 billion or more, I change that, and the updated query is now run. And then if I want to restore it back to the save query, just reselect candidates, brings that query back in again and executes it. Next is narratives that we'll be talking about later in this video, but this is the worksheet where narratives are actually stored. Typically you don't need to view this, so it can be hidden. PolarisData contains data retrieved from the back-end Polaris database. The values on this worksheet are referenced in the valuation worksheet. This worksheet can be hidden as well. Next is the About worksheet, which is pretty much what we're going through now. We just went through the comparison to the Polaris website, how to go get it, and now you can see here we're talking about the tabs. Assume that once you get familiar with the app or using the spreadsheet, you can hide this About as well. And we've already been through the Dropbox worksheet, so I'm going to hide it once you've downloaded it. And that leaves us with really the valuation worksheet is the only worksheet you need to keep unhidden to use the spreadsheet. The remainder of this video will be focused on the valuation worksheet. First thing I want to point your attention to is the fact that the formula used by Polaris in calculating the valuation is shown. And go into a little bit more, I'm going to go over here to the About section and enlarge what's written about this section of the valuation worksheet. And it's not shown on the valuation worksheet, but I want to point your attention to the idea that the model is a two-stage model, which means that there's a certain growth, sales growth assumed in the first part of the formula. Usually this is set to 5 years, but in the spreadsheet you can change that to any length of years you want. And then the formula itself is calculated such that there's just an immediate change to a second stage, which is more the growth rate that you would assume that happens into perpetuity after this first stage. So it is a two-stage model. But an equivalent way to think about it is that here in the first stage you can conceptually think of that whatever growth you set to, that really starts off higher and then gradually transitions to the growth in the second stage. This is referred to as the H model, and the growth that you enter into the formula would just be an average of whatever high growth you want to assume at the very start of the first stage, and then where you eventually end up into the second stage. Now the formula itself, as mentioned before, can be thought of in two stages. So what we're showing here is a very high level conceptual view where you've got these near term cash flows and then you've got a terminal value. A more precise way is a formula provided by Dr. Damodaran from New York University. And then here at the bottom is shown the simplified, roughly equivalent formula to this precise formula. So for those who are interested in knowing more of the details, I invite you to come out here to the Polaris Investing site, go out to the YouTube link, and scroll down to the bottom, and you'll see a playlist called Valuation Concepts. When you view that playlist, there's two videos that I suggest you watch to learn more about the derivation of the formula. First one is on called Useful Accuracy, Theoretical Calculation, and then even more in-depth coverage of the formula is discussed in the Cash Flows video. Those are the two main recommended videos, but there are other videos on the Polaris Investing YouTube channel that may be of interest to you, so I suggest you look around these different playlists. Now another video that comes to mind that you may find useful in explaining the Polaris valuation formula is here in the Valuation Calculation playlist. Is a video called Valuation Calculation Formula. This is a very brief, high-level discussion of the formula. Since this video was originally recorded, links to the videos just discussed are now in the Polaris Valuation spreadsheet, namely here. A key concept in the Polaris Valuation formula is the use of sales and sales growth. If you compare that to the precise formula, it's based on earnings and earnings growth. So the question comes up, why does Polaris use sales and sales growth versus earnings and earnings growth? Well, it comes down to is if you look at an income statement, sales is at the top of the income statement, and then cost of goods sold, some period costs, interest charges, taxes, and finally net income. Working from the bottom of the income statement requires dealing with a lot of detail as shown in this forecasted pro forma income statement over several years. Polaris Valuation formula uses sales and a future profit margin to capture these details. Another benefit is avoiding negative earnings. Around 20% of companies report negative earnings in a year. All right, let's turn our attention now to the use of the spreadsheet. The primary cell that you will interact with is the cell E2, where you enter the stock symbol or ticker that you're interested in. So let's say we're interested in Walmart. Type in Walmart, hit return. And what we'll see here is it comes back with the current price and the date that it pulled that price for, and then the change in price since the preceding trading day. It also tells you the name of the company. Since recording this video, there are additional ways to enter a ticker. Set it by the name of the ticker. You can come up here in the cell right above E2, and you can type in the first part of the company name that you may recall. For instance, if you type in micro and with an S, then hit return, it'll come back and it'll say, are you talking about Microsoft? And if you reply yes, it'll automatically substitute that into E2. And another example, if you were to type in, say, JI, and then a wildcard, it'll find the first company name that satisfies that condition. You can see here it finds this company. I'll put no here, and then it'll just stay with the ticker that you previously entered. Another new way that's been added to enter a ticker is to click on the cell F2. What it'll do is re-enter the same ticker that's already in E2, as if you retyped again the same ticker in E2. The advantage of this quick enter is that because a new ticker essentially is entered in, it will clear out all the user input values and essentially reset, also update the price if you're in the middle of an active trading day. So let's click it here, and you can see here the price is updated and all the user input has been cleared. Another way now to enter a ticker here in E2 is to select the drop down, or you can continue to type in. Let's say I type in a ticker IBM and then go look at the drop down. You'll see the drop down actually grows with each new ticker. The most recent ticker that you typed in or selected is at the top. Now the way that that's actually implemented is here in the Manage tab. There's a column here, M, that keeps a list of all the tickers. And here in cell L1 is the current number. You see here reading the note that the maximum you can currently enter in it is 10 unless you come into this worksheet and enter explicitly more than 10 or however many you want. Let's say you entered it explicitly 12, then it would allow up to 12. But without explicitly entering tickers in column M that are more than 10, it'll cap off at 10. Now the maximum you can do is 100, but as you input more tickers or select, let's say come here and select Walmart and then go look at the drop down, you'll see that Walmart is now at the top of the list. Since this video was originally recorded, there are now other drop-down lists that can appear here besides what's referred to as the managed list, which we just went over. Which list appears in cell E2 is determined by cell B2. By just clicking on that, you change the drop-down list. Right now we're showing the managed list. The managed list is maintained over here in the managed worksheet, namely in column M. So as you add new tickers that are added to that managed list. But if I want to have an alternate list, I click on B2. It's showing the portfolio. And now when I do the drop down, I see a different list of stocks. And where the portfolio list is coming from is this column P. But I can choose which of the lists that I want to display in column P by selecting here. So if I want to say, let's say I want to back it up to column Q, now you can see here that the portfolio that's listed in column Q is now the portfolio list. So over here on the valuation sheet, you can't pick different portfolios, but you just pick the portfolio. And then on the Manage tab, you pick exactly which portfolio list you're wanting to use. Another option is to click on B2 again. Now you get the topical list, and I don't currently have that unhidden, but if we go and unhide this topical, you see this list of stocks that are there. And then you can click on B2 again and get with the candidates off the candidates worksheet as a result of running this query, and then it shows the list of stocks here. And this is also the default list. Next, you'll see in the section below where the price is shown is a series of values labeled Polaris Default. These are values that are pulled from the back-end Polaris database based on the ticker that you enter that shows the default values used on the Polaris website. To the right of that is a place for user input. You notice the background of those cells are gray. The first three inputs have slightly darker gray backgrounds. Darker gray backgrounds indicate common user inputs. Common user inputs correspond to sliders on the Polaris website. So for instance, if I want to overwrite the default value, which column F shows the actual values currently being used in the formula, but if I want to enter, let's say, a 3% profit margin instead of 2.3, it now updates to show that we're using a 3% value in the formula, and therefore the theoretical valuation that's shown over here in cell O2 has changed. Now if I clear that out, you'll notice that the valuation goes back. Now I'm going to do that again and show you yet another way that you could quickly clear that out. Instead of right-clicking and selecting Clear Contents or going into the cell and backspacing, you can also come over here to column A and just click in the cell corresponding to the row in column E you want to clear. Other values that are pulled from the back-end Polaris database are in this section here titled Other Values to Consider. Now these values correspond to the Polaris website, namely like here for the sales growth slider, you see that there's other values being suggested besides the default, namely one for the company, industry, and the S&P 500. Well, that's 2%, minus 13, and 7. Here it's shown as 2.3, 13.0, and 7.0. So it's just this. The website only shows it to whole integer, whereas here the values are being shown to one decimal place. So you see that both for the sales growth. That's what these three values are, corresponding to the Polaris website's sales growth values. Then we have three values corresponding to the profit margin, and then three values corresponding to the PE multiple. So that's, here it is, the profit margin and the PE numbers. Now here on the website, if you wanted to quickly change the slider to like an industry number, you just click on it and the slider changes. The way you do that here in the spreadsheet is you just click on the value. So right now there is no user input, but if I wanted to change it to let's say the profit margin to 2.1%, I would just click on it. It automatically populates it in the cell. I can restore back the default by just clicking here in this column where it's labeled Restore Default, or I could have it entered in automatically and then go to this other approach that I showed you where you can click over here and clear that user input. And without any user input, it goes back to the default. All right, let's go back here and let's make sure we understand how these different variables and lookup values are actually used in the Polaris valuation formula. First of all, what's the distinction between a lookup value and a variable? Well, lookup values is a fact. It's something that really you shouldn't overwrite, but you may have a different source than what Polaris is using and identify maybe the dividend is slightly different than what the default is showing, or what you consider to be current sales is slightly different, or current shares. But these three values are basically facts, whereas these other 6 values called variables are something for you as an investor to think through and either take the default or enter your own values for these variables. Well, let's map these values into the formula below. So first off, here is the sales growth. And sales growth is shown as GS down here in the formula. Future profit margin is shown as future PM. We have a future PE, and that's shown as future PE here in the formula. Competitive advantage period, also sometimes referred to as stage 1 or Y. It's the number of years in that first near-term cash flow period, and that's shown here Y, and it's also over here as an exponent. The shares growth is used to calculate future shares by taking 1 plus shares growth to the Y exponent times current shares. And then cost of equity is shown here. Now over here are some intermediate calculations that are used in coming up with the final value for the valuation formula, which is shown up here. So in this case of Walmart, it's $145.75 is this discounted cash flow value using the Polaris valuation formula. Some interesting intermediate calculations, one of which is future shares, which is used in the formula, and here it's actually calculated as mentioned earlier. Future sales, which is shown in the formula, is current sales times 1 plus the growth of sales to the Y. But here it shows the future sales. Present value of dividends, that's the dividend times Y. Again, go watch the videos that were referenced earlier as to why that's being used as the stage 1 cash flows. Since this video was originally recorded, an area has been added for user to override some additional lookup values, namely these values here. So in the past we had return on equity, sales to equity, current profit margin, and then the payout was over here, and then the industry cost of equity was placed here. But there was no way for a user to overwrite them except for writing directly in these cells. So now, similar to how user input is done on other parts of the spreadsheet, you can now override those conveniently with this area that's been added. These 3 values here are new, and they're not used in the valuation formula that results in this present value number shown up here. They're intended more for advanced users, although one number here, the debt to capital, is of interest to most users. These numbers are used to calculate a valuation based on an alternate valuation formula. The valuation calculated from this alternate valuation formula is displayed here. Since this area is intended for advanced users, the details behind the valuation calculation is not on the valuation worksheet. It's contained in the PolarisData worksheet, namely here. The value displayed on the valuation worksheet is selected from this column, and it's typically this value here. Which value out of this potential candidates is actually determined here. You can see here it's set to Y18, which is this value. The valuation formula used is referred to as a single stage free cash flow to the firm valuation model. If you are unfamiliar with those terms, it is suggested you take this link and watch this video on cash flows, and take this other link to watch a video that talks about the derivation of this formula. Down here shows basically how the formula is determined, and it boils down to that you end up with a geometric progression of which the present value of it is such that you get this formula here, which gives you the business value. So once you've calculated the business value, you subtract off the debt and then divide by the number of shares to get a price per share. Now if you assume that the projects a company works on return on invested capital equal to the weighted average cost of capital, this formula simplifies to the following, and that's what's shown in this row here that's partly in blue and in green, and that's the price that typically is referred to when you're looking at a valuation from this alternate method. The other prices shown in this column correspond to different return on invested capital that's greater than the weighted average cost of capital. In that case, you're back to the original formula. And so let's take an example here that you're earning, projects are earning 9%, but expectations with the weighted average cost of capital is 4.6%. So now you see the price is 106 versus 77. As already mentioned, this valuation model that we just went through is a single stage free cash flow to the firm. But there's an equivalent model that's single stage free cash flow to the equity holder or stockholders. It is the same geometric progression, but you're discounting back cash flows that are only for the equity holders, whereas over here you're discounting back cash flows that are destined for both equity and bondholders, and that's why when you're done you have to subtract off the price of bonds. But so the right half of this table up here just shows you that you could have done it with these numbers here and ended up with the same price that you had with this model. The values used by this model are shown here, and in gray is user input. Now by default this net operating income is pulled from the Polaris backend database and it's shown here, but often that needs to be looked up by taking this Reuters link and looking and deciding yourself what is a normalized net operating income to use. Other values that are used is the cost of debt and the tax rate. Those two pieces of information are usually somewhat consistent across all companies. Another important input value is the debt to capital ratio, and make sure you understand that these are market values when we talk about debt, and then debt plus stock value. So stock value is current market price times outstanding shares. I want to stress it's important to use the market prices of debt and stock. And just for comparison, down here we show the current book value of debt to equity, but there's no relationship between accounting book value concepts and economic value. So you can see here that when we use market prices, we're at 10% debt to capital, but using accounting book to equity, it's 34%. The debt to capital ratio is part of a bigger discussion on capital structure, and it involves some results from two famous professors from the 1950s and 60s named Modigliani and Miller. And if you need some brushing up on these concepts, I suggest you take this link here and watch a video on capital structure. But what Modigliani and Miller showed is that there's some specific results that can be derived such that when you change your capital structure, the amount of market debt to total market capitalization, you can forecast what the effect of those changes would be. If you're interested in forecasting change in price based on some anticipated change in debt to capital structure, you can enter the new debt to capital structure up here. So let's say 20% instead of current 10%. You can see that the price has changed, or I can change it to 40%, or just want to see what the possibilities are in terms of future price. So once that change is made, these are now the values that apply in the numbers that you see. Whereas if you clear it and go back, then the numbers here and here are the same because you're not entering in any different debt to capital ratio. So back up where we started from here, is we were talking about this additional information that's now available on the valuation worksheet. And we talked about net operating income and debt, and then made reference to this alternate valuation you can compare to the valuation that's done on this worksheet, and then that led us to this analysis here. And this analysis really is for advanced users. All right, next let's talk about this area over here titled narrative. And like the note for the cell indicates, narrative is essentially your story behind the values you are using to calculate a valuation. Narratives are similar in concept to plans up on the Polaris website. See if you had saved a plan like here for Walmart. Scroll over to the right, there's all kinds of data that was used in calculating the valuation. There is no text to describe the story behind the numbers. Back to using narratives in the spreadsheet. So what you do is you enter a ticker and you want to record some notes, you would enter them here. Since this video was originally recorded, you can now quickly populate your narrative with a template by clicking on cell AB1. A template containing some things you might want to consider commenting on is found in the narrative worksheet shown here. Now let's briefly talk about some of the things. One is to, at the very top, to state clearly your overall assessment of buy, sell, whatever decision you've reached at the point that you're writing this narrative. Maybe come back and every time you revisit the narrative, updates with some recent news that's impacting your stock. Have some company information, maybe identify some key personnel, something about the company you want to make note of. Anything going on with stakeholders. This includes both stockholders and customers, employees, board of directors, activists. Also, clearly identify strategic competitive advantages that this company has. And here's a list of some things for you to consider. Total addressable market and the likely percentage of that market that you feel like the company's going to have. This really comes into play when you think through what you're going to go with for your sales growth. Next section, you should document your thoughts around the key input values, namely growth of sales, future profit margin, future price earnings multiple, and the number of years in the competitive advantage period, namely Y. And then hit save. And once you save, you notice that the values that you used in the valuation calculation are also saved. So for instance, if I were to switch over to another stock now, I would see that I haven't previously saved any kind of narrative for that stock, but if I come back to Walmart, it will bring back my previously saved narrative and the data used in the previous valuation. Now, if the default values have changed since the time I saved my narrative, I can quickly restore values back to what I had when I originally saved the narrative by just either clicking each cell individually or clicking on cell S1 to toggle restoring narrative values and clearing formula inputs. To remove a previously saved narrative, just simply come over here and clear out the cell, hit save, and you'll notice that the values that were previously saved are now cleared out. And if I were to enter in Walmart again, no narrative is found. You should rarely need to view the narrative worksheet, but on occasions it could be beneficial to do so. What's stored on the narrative worksheet is the values that were saved with the narrative. For instance, there's the actual text of the narrative and other values. Now here in column W is just a template that you may want to use as you write new narratives. But on the other side of column W, there's some additional values that are stored for every narrative that deal with the defaults cost of equity for stage 1 and stage 2, and then the values that go into calculating those default cost of equities. On occasion, it could be worthwhile to go back and if you're reviewing where the actual cost of equities that were used in the calculation may have come from, you can at least go back and see what the default values were for those cost of equities. With that quick overview of how this worksheet is set up to work, let's compare the results of the formula coming from the spreadsheet with the results out there on the Polaris website. So here we've entered in Walmart and have entered it here after the market is closed, so don't need to refresh it. Now if I go out there and look at what the website is showing, it's showing for the theoretical valuation of $130.84, but the value that the worksheet is showing is $145.75. So the question is, if they're pulling both from the back-end Polaris database, why do they show different numbers. Well, let's compare to what's being used. Here on the website, we're seeing that a sales growth of 8% is being used, but the default value that's being used in the worksheet is 9.9%. So that's at least one difference. The profit margin is 2.3. It's the same on the website. 18.4 for future PE. It's 18.4. 5. When we scroll down here, that's always the only value that's ever used for Y is 5. Shares growth the same. Cost of equity is 3.3%. That's the same. The dividend, yeah, we could calculate by taking the dividend yield times the price, but it's done that. It's $2.20. The shares, current shares, that's shown here, and that's shown as 571,637. Well, that's different. And then current shares can be calculated based on future shares and the shares growth, and we've already done that, and that is the number 2771. The two values that are different from the website have yellow backgrounds, right? And they will be different for every stock. So if you want to match the exact number between the website and this worksheet, you'll need to enter the same values. Now, why are they different? Well, the gross of sales, they're different because of the rounding and some things that are done that are slightly different. And again, the default value is just a starting point, particularly for growth in sales. But if we wanted to match it more evenly, we would type in 8%, and then you see here it's already backed it down to 134. So we're getting really close. Now again, if we go down to the bottom and see what the current sales was being used, it's 571. So let's change the current sales to 572 million by entering the new value here in cell E13. And now you see the valuation is almost the same as what's shown on the website. The reason that the numbers are still not exactly the same is that current sales and current shares are shown in millions, but the actual numbers used in the calculation are precise down to the decimal point. As mentioned earlier, the default sales growth is slightly different than what is on the website. This default sales growth is used in the calculation of the default current sales. The calculation takes the most recent end of fiscal year sales and based on the current date moves those sales forward to the current date. Sales are moved forward by using the default sales growth. So if the default sales growths don't match, the default current sales won't match. Note that changing the sales growth, like we did here to 8%, in the spreadsheet does not change the default current sales in the spreadsheet. Default current sales is retrieved from the Polaris database. In the spreadsheet, current sales is changed by entering a new value in cell E13. Well, next, I want to concentrate on this area of the valuation worksheet and talk about what this color coding of blue and green means as it relates to this graph. So, and this is what we got going so far for Walmart is when we updated the price last, it was trading at $134.01. The valuation was coming up at $145.75 based on the default values pulled from the Polaris database. Well, if you look down here in the intermediate calculations, the future value is $171.44. And how you move from a future value to the present value, then have a present value that can be compared to the price. You just simply take the future value and discount it back, in this case 5 years, using the cost of equity here of 3.3%. Now, the present value and the future value cells will always be colored in blue to reflect that these 2 points reside on the valuation line shown in the graph. In the case of Walmart, the future value of $171.44 can be thought of as being this point here, and the present value of $145.75 is here. And as time progresses over the next Y years, we're expecting the valuation to increase from the present value to the future value over the next 5 years. The rate of change, or the slope of this valuation line, is approximated by the cost of equity, which is shown up here, 3.3%. That's fairly straightforward to see because the way we got to the present value from the future value is we discounted back at the cost of equity over 5 years. The other line on this graph represents price movement over time. And right now we have a price that is below what we consider is a fair present value. So in the graph, that green point representing the current price is below the current valuation. And what's expected is that over the next Y years, the price will move up to the future value. So you start off with a present value and a current price, and then they both take separate paths to the same future value point. As we already discussed, the present value moves up at an annual rate of the cost of equity. The price, though, will move up based on this value here of 5.1%. The calculation of the 5.1% can be seen here, but it simply uses the current price. And knowing the future value and the time frame the current price is expected to equal the future value, it calculates an annual change needed for this current price to eventually meet up with the future value. Notice that the stage 1 cost of equity is not directly used in this calculation. Recall, stage 1 cost of equity reflects the riskiness of cash flows during this first stage. Stage 1 cost of equity is primarily used as a benchmark to which this investor's rate of return is compared to. The difference between the investor's expected rate of return and the cost of equity is called alpha. Alpha is the amount of return above or below the cost of equity. Alpha represents essentially a mispricing or market inefficiencies, providing an opportunity for investors to earn returns above or below market expected returns for the risk taken. Riskiness of cash flows in the period following the competitive advantage period are directly incorporated into the valuation formula through the future PE. So you can see here in the first term, that's the cash flows in the competitive advantage period. The second term captures the cash flows in the terminal value period, and it's the riskiness of those cash flows is primarily reflected in this future PE. Let's revisit why stage 1 cost of equity is a minor factor in the ROI calculation. To calculate the future value, you multiply the present value by the cost of equity factor. In the second term, the cost of equity factors cancel out. In the first term, the approximated present value of dividends are multiplied by the cost of equity factor. Since the majority of valuation is from the second term and only 40% of stocks even pay dividends, the future value of dividends has a minor impact on the future value and thus the calculation of the investor's ROI. Now, the cost of equity is calculated based on the beta of the stock using the capital asset pricing model, and it reflects what the risk-adjusted rate of return is expected for the stock, assuming that you're on the valuation line. So if the stock was currently trading at $145 and over 5 years were to move up to $171.44, you would expect, based on risk, which is typically approximated by historical price volatility, that you would be compensated earning a rate of 3.3% per year. But we have a situation here where, based on our valuation, we think the current price is below the fair value for the stock. In other words, the price is down here. So we're actually going to earn a return above the cost of equity by an amount of 1.8%. And that additional amount over the risk-adjusted expected return is referred to as alpha. Now, buying a stock at a price that you consider is below the current valuation provides a margin of safety. In this case, the alpha is a positive 1.8%. You could be off a fair amount and still get the cost of equity, but if things work out as expected, you're going to earn an additional 1.8%. Bottom part of this graph here shows likelihood of return. And if the current price equaled the current valuation, we'd get a distribution of returns that looks like this, with a mean of the cost of equity. But since we have alpha, this distribution shifts to the right. We have a higher likely mean return. We have the same spread of returns, but it's around a different mean. If the current price was above the valuation, then it would shift the other way and we'd have a lower mean, essentially a negative alpha that would reduce the expected return below the cost of equity. You can see this if the price for Walmart is changed to be higher than the current valuation. You notice the background of the color changes to purple, the alpha changes to purple, and it's just reflecting that we're now over here in the curve where we got a price higher than the valuation, and therefore a negative alpha and a lower mean of only an expected return of 0.8%, versus when it was the other way around, where the price was below our valuation, we had a expected return of over 5%. Now this blue valuation line, which is based on the stage 1 cost of equity, serves as a baseline to determine if you are being equitably compensated for the risk you're taking. You can see here in this latest price that we put in for Walmart, even though the price is much greater than the current valuation, we're still making some positive return, not much, but at least we know relative to what we should expect to make, we're making below what we would want to make based on the risk we're taking. Another approach that is commonly used is where you don't have a baseline of cost of equity, you just simply define a return that you're interested in making, and as long as your forecasted return is above your required return, you would consider the investment worthwhile. This approach is promoted by an author named Phil Town in a book called Rule Number 1 Investing. Well, a concern with this approach is, let's say that this number was 15%, but the cost of equity was 20%. Using that approach, you would make a decision to go ahead and invest, even though you're not being equitably compensated for the risk inherent in the stock. This would be analogous to going to a racetrack and deciding to bet on only very high payoff horses, because that's where you can get the highest return, or returns that exceed your expectations. But that doesn't compensate you for the risk that you're taking. Using this approach, your winnings would likely be less than expected because of the likely variability of returns or risk. But if you were to focus in on alpha opportunities and look for horses that more than compensated you for the handicap or risk that you're taking, that would be a more prudent betting approach. I want to briefly mention another approach championed by Warren Buffett, in which cash flows are discounted back at the risk-free rate of return, which is typically approximated using the 10-year Treasury bond yield, currently at around 2%. A present value above zero is considered a potential investment. This approach is actually equivalent to discounting cash flows back at the cost of equity. Equivalency is from the different type of cash flows used in each approach. In the cost of equity approach, each cash flow is assumed to be an average cash flow. Discounting at cost of equity accounts for the distribution of those cash flows around their mean, or essentially their risk. Discounting average cash flows back at the cost of equity separates cash flows from their risk because their riskiness is accounted for in the cost of equity. Buffett's approach uses certainty equivalent cash flows. Cash flow expectations are lowered to the point that they are assumed to be guaranteed. Since the cash flows are certain, they are discounted at the risk-free rate of return. Discounting certainty equivalent cash flows at the risk-free rate mingles cash flows with risk, making the cash flows more difficult to forecast. This is one reason Buffett tends to invest in value stocks and stay away from growth stocks. Value stock cash flows are more certain. All right, let's go back to the input values and discuss approaches to determine defensible values. So let's start off with sales growth. Let's say you want to think through and possibly override the default growth for sales. Well, there is a link here that's provided. I suggest you take that link and it'll take you out to the CNN site, and if you select forecasts and scroll down, it will give you a forecasted growth in sales, at least this site through the analysts it's pulling came up with. So you can see here we're assuming almost 10%. This site is actually currently suggesting minus 1.5%. So it requires some work to go through and figure out where you want to land. Another thing you can do is go over here and look at this other values of interest section and look at the growth of sales that the market is implying with the current price. And the way this value is calculated is that this uses the valuation formula, and it assumes all the other input values are being used by the market, and based on the current price calculates for the growth of sales. So here you are assuming a default of almost 10%. Market seems to have built in around 8%. Since this video was originally recorded, this graphic at the bottom of the valuation worksheet has been added to highlight another important comparison you should make when you think through growth of sales here in the first stage. And that is you compare the growth of sales in the first stage with the implied growth of sales in the second stage. And those two growth values have been put in a background color of gold to relate to this graphic that's shown here at the bottom that shows in gold the stage 1 and the stage 2 growths. And so you need to understand, well, what growth are you assuming in stage 1, and then what growth are you assuming in stage 2? Now, if you recall, the H model has another way of interpreting that. That's this dotted line. And that value is shown up here, in this case for Walmart, it's 13.7%. So you think about 7.8%, first stage, here we are, drop it down to 2%. But another way to think about it is you start off at 13.7% and over a 5-year period drop down to 2%. So you got to think of whether that makes sense that you would have that big of a difference between a stage 1 growth and stage 2 growth, particularly for a company like Walmart. So those are some ways you can think through growth of sales. Next is the future profit margin, and here's a site that you can use to go off and look at the current profit margin. You see down here the profit margin is currently 2.42%. And I want to stress that you're trying to think through the future profit margin, which is in this case 5 years from now. So a number that you want to compare that to is what is the industry standard profit margin? Do you think that the future profit margin will be more like the industry? Or could it just continue on at its historical average? Or could it become more like the average profit margin for a company in the S&P 500 index? Also, for profit margins, you consider the operating leverage, which takes account fixed costs versus variable costs. It is recommended that the majority of your time be devoted to coming up with defensible values for sales growth and future profit margin. The importance of these two input values is captured in a quote from Gary Gray, a professor at the Wharton School of Business at the University of Pennsylvania. He wrote, "The ability to forecast sales and profit margin is what separates the all-American stock analysts from their lower-paid kin." Next is the future price earnings multiple. We're going to skip that for a couple minutes and come back to it after going through the remaining input values. Now, competitive advantage years, this is something that really is the art and evaluation to think through how many years you think a company can stay, earning the growth rate that you're assuming. For the majority of stocks, the default value of 5 years is sufficient. The duration of the competitive advantage period can have a significant effect on valuations, so it should only be extended after careful consideration. Next is shares growth. This value is a little bit difficult to come up with, therefore it's best to just use the default value. But if you were going to try to come up with think through your own value, one way to do is think about historically how many shares have been outstanding for the amount of sales, and then try to do some trending around that relationship between sales and outstanding shares. Lastly, cost of equity. And this note here shows the calculation of the cost of equity. But if you're going to input your own value, I suggest you think of the cost of equity as an exercise in categorizing as opposed to calculating. Your assessment of financial risk, debt versus equity, and operating risk, fixed costs versus variable costs, should be incorporated into your thinking about uncertainty. As you see in the bottom of the note for the cost of equity input cell are some suggestions on how to do categorization. If you think a company's operational cash flows are highly uncertain over the next few years, then you should consider making the cost of equity 5 to 6 times the risk-free rate. By the way, the risk-free rate is shown here in cell G11. If your assessment is cash flows are moderately uncertain, then consider making the cost of equity 3 to 4 times the risk-free rate. And finally, if you think the cash flows are fairly certain, then consider making the cost of equity 1 to 2 times the risk-free rate. If you are interested in checking your categorization of cost of equity, go to the PolarisData worksheet. And down in this section of the worksheet is information on the calculation of the default cost of equities, both for stage 1 and stage 2. And you can look at the notes for different cells, figure out how those default values were calculated, and wanted to try to do something like that for calculating your own assessment of cost of equity. Since this video was originally recorded, the beta used to calculate the stage 1 default cost of equity is now shown down here in this information section. To the right of it is the raw stage 1 beta from Reuters, and below it is the stage 2 beta used in the default future PE multiple calculation, and below it is the industry average beta. Betas represent relative risk compared to the overall market. You should always consider whether the stage 1 beta has been overly dampened away from the raw Reuters value. You should also consider whether the stage 2 beta is overly dampened to the industry beta. Since betas are primarily factored into the valuation calculation through the future PE, it is suggested you click on cell G8 to see other possible future PEs based on different stage 2 beta values. Remember, the cost of equity here in stage 1 is a relatively minor factor in the calculation of the investor expected return, RI. It is primarily used as a benchmark to determine alpha. Well, let's now back up here and talk about the future price earnings multiple and the kinds of things you need to think through if you're going to be overriding the default value. I want to quickly point out that there are 3 videos whose links are provided in the worksheet. One here, when you click on future price earnings PE multiple here, you'll be taken to a video that discusses much of what we're talking about now. Then there's also a second video that we'll be talking about its content when we're talking about the derivation of the PE multiple in this perpetuity link. And this other link goes along with the discussion on future PE scenarios. Well, first off, let's talk about this, what is meant by price earnings multiple. Most people answer with price divided by earnings. When asked what that means, the typical response, how much a dollar of earnings is currently valued by the market. With that definition, if you could determine the proper PE multiple, you could just take that multiple times the current earnings and come up with a valuation, compare that valuation to the current price. Well, the problem is, as stated by Burton Malkiel here, that God Almighty does not know the proper price earnings multiple for a common stock. Now that's quite a statement coming from Burton Malkiel, because he is the one that came up with the idea of a two-stage valuation model consisting of near-term cash flows and terminal value to come up with an overall valuation. Later, he wrote the book Random Walk Down Wall Street in the 70s, and here we are 50 years later, and it's on its 11th edition, in which Burton Malkiel advocates not attempting to value individual stock, rather do passive index investing. Burton Malkiel came to the realization that most investors lack the necessary skills and discipline to be successful at picking individual stocks. What follows is a disciplined approach to applying a form of Malkiel's two-stage valuation formula and a quantitative interpretation of the future price earnings multiple. Let's first revisit the Polaris valuation formula. Make sure we understand where the future PE multiple fits into the formula. First off, we have the near-term cash flows, which is just the dividends. And then the second term, which is typically over 70% of the total valuation. You take the current sales, we grow them for Y years, multiply by a profit margin, which gives you earnings, divide by the future shares, that gives you earnings per share. Then you take future earnings per share times this future PE multiple. So valuation is dominated by two main values. It's the future earnings per share, but you need to know current sales, a reasonable growth of sales, future profit margin, but you end up with a future earnings per share and then this future PE. This is apparent in analysts' detailed cash flow analysis. Eventually they end up with some cash flow in the last year of the near-term cash flows that they multiply by a terminal value factor to end up with a terminal value. And like this shows, almost 90% of the total valuation in this very explicit cash flow analysis is in that terminal value, driven by two main numbers. Final cash flow number coming out of the near term, and then the terminal value multiple. We've already discussed the terms that go into calculating the cash flow or earnings per share at the end of the near term cash flow period. So now we're going to discuss the terminal value multiple, which will be referred to as simply the PE multiple going forward. To understand the math behind the PE multiple, let's look at the general idea behind most valuation models. They look at the future. In this case, we're looking at returns that are being forecasted over the next 20 plus years, and then this ... that says it could go on forever. This kind of forecasting is impossible to do annually, year over year over year, well into the future. So what is typically done, you break the future up into some chunks of time, 5 years, 10-year chunks of time, and then come up with an average. So here's an example. The first 5 years took an average return over those years. The next 5 years, and so on. But even then, you end up with so many chunks of 5-year periods that it makes it impractical. So what's the next step then is to include more years per chunk. Instead of doing 5-year chunks, you reduce it to 2 chunks or stages. You're focusing on the near term, and then you have a terminal value period that goes on forever. And that's what we're talking about with the PE multiple, is it's really representing these cash flows that start in after the near term and go on forever. They are a perpetuity series of cash flows. It can be shown that a perpetuity series of cash flows can be reduced down to this formula here. This formula simply says take the next 12-month earnings times 1 minus the reinvestment rate, which is your distribution rate. So what percentage of earnings get distributed, and then divide it by the cost of equity minus the growth of earnings. You divide both sides by earnings, and you get a price earnings multiple consisting of the distribution rate in the numerator, and in the denominator is the cost of equity minus the growth of earnings, where the growth of earnings is equal to the return on equity times the reinvestment rate. Now, if you're interested in the derivation of the formula, I suggest you follow this link, marked perpetuity, and it takes you off to this video that goes into extreme detail on how you end up with a formula. And in this case, you end up with, if n goes to infinity, this middle term becomes 1, and you have the formula that we are showing here. Now notice you end up with a formula that has 3 distinct terms in it: the reinvestment rate, cost of equity, and return on equity. The reinvestment rate appears in both the numerator and the denominator, making the PE multiple difficult to calculate. It is best to use a spreadsheet to easily compute the PE multiple. Well, now that we've got a quantitative definition of price earnings multiple, let's go back into the spreadsheet and see the impact of making changes to the future PE multiple. To assist in understanding the significance of a change to a PE multiple, this area of the spreadsheet will be used along with this area. When a user makes a change to a PE multiple, there's usually one of 3 scenarios that they're considering. The first scenario, referred to as the no growth scenario. Second scenario is there's some kind of cap growth they're considering. And in very rare situations, they may be considering an uncapped growth scenario. These 3 scenarios all have to do with just how much return on projects or return on equity you think the company's going to be able to do into perpetuity. The more you think the return on projects is above the cost of equity, the higher the valuation. Important to keep in mind that the return on equity times reinvestment rate is earnings growth, and without considering the implications behind the future PE multiple, it is easy to end up with unrealistic earnings growth. Thus, it's important to scrutinize earnings growth implied by the future PE multiple. Well, let's talk about this first scenario, which is the no growth scenario. Now, to be clear, we're not talking about no growth of earnings, because growth of earnings is the reinvestment rate times the future return on equity. So you can have reinvestment and therefore growth in earnings. What we're talking about here with no growth, we're saying no growth in value, meaning we are assuming the company is just going to earn the required return on equity, namely the cost of equity. And so we take the standard formula here that we derive for price earnings, and now assuming that the return on equity is equal to the cost of equity, we can work out the formula and see here that when we set the growth equal to the cost of equity times reinvestment, that we end up with this simplified formula for future price earnings multiple, which is just the 1 plus cost of equity divided by cost of equity. Now, in this scenario, you'll see here that the reinvestment rate is irrelevant because it's factored out of the equations. And that means whether the company decides to pay back all of their earnings to stockholders, and the stockholders can turn around and buy more shares, they could continue to earn cost of equity. Or the company themselves could just retain earnings and continue to invest in projects that make cost of equity. So the amount of reinvestment, therefore the amount of growth of earnings, is at management discretion. Now let's show that increasing reinvestment rate doesn't change the valuation if you're assuming the return on equity equals the cost of equity. So it defaults to 33% reinvestment. If I up it to 40%, You notice up here in the valuation, it stays at $118.44. If I up it to 50%, if I up it to 80%, it doesn't matter what the reinvestment is, beyond making a difference in terms of the earnings being reported by the company. With more reinvestment year to year, there will be more earnings, but you're not increasing the value by increasing the amount of reinvestment when the return on equity equals the cost of equity. So when interpreting what a future price earnings multiple means in the no growth scenario, you're just having to consider the cost of equity into the future. And by the way, this is the scenario that the Polaris website defaults to. It assumes that the future return on equity is equal to the future cost of equity. This is the most probable scenario for most companies. Competitive pressures cause a company's competitive advantage to fade, resulting in return on projects mean reverting to the cost of equity. Let's use a spreadsheet when we are dealing with a company that we feel like is more in that scenario where there is no growth in value. You can see here for Walmart, the default price earnings multiple is 17.8, but it's assuming a cost of equity in the terminal value period of 6%. Well, just like with the cost of equity in the first stage, here 5 years down the road, since we have set Y to 5 years down the road, we got to give some thought to what is the likely categorization of cost of equity for Walmart. And just like with cost of equity 1, you can think of it in terms of 3 different groups shown at the bottom of the note here. Or do a similar calculation that was done for the default cost of equity, which is shown in the PolarisData worksheet. As briefly discussed around the 50-minute mark, since originally recording this video, some beta values are shown here in this information section. Since betas are primarily factored into the valuation calculation through the future PE, suggests that you click on cell G8 to see other possible future PEs based on different stage 2 beta values. Walmart likely fits more into that low group where the cost of equity should be thought of being around 2 times the risk-free rate in 5 years. Risk-free rate in the spreadsheet is shown here at 2.5%, so it makes sense that 6% is a little high, so let's back it down to 5%. Now you notice as soon as I make that one change, it's flagging with the orange that we're no longer in equilibrium. No longer is the future return on equity equal to the cost of equity. So what you want to do is come back up here to the price earnings multiple and get it aligned with the 5%. And it's showing here that in this cell 21 would make it align. So we type in 21 and now the orange disappears, and you can see here that we now have a PE multiple that reflects a no growth scenario where the cost of equity is 5%, and then we go up here and look at what that did to the valuation. It's now $138 versus a current price in the market of $134. So when you're dealing with this most common scenario, you make an assessment of what you think the cost of equity is, change it to whatever you're thinking, and then make sure that your PE multiple is aligned. In other words, until the orange disappears. And in this case, since I'm returning it this back to the what it defaults to, then we have it. Once the orange is gone, it means you have it aligned. Okay, let's go to this next scenario where we assume that the return on equity is larger than the cost of equity. Therefore, we are going to have growth in value. But by doing that, the simplification that we had earlier in the no growth scenario no longer applies, and now we're dealt with the original formula that has cost of equity, reinvestment rate, and return of equity in it. Even though the formula has return on equity in it, in this cap case, we're going to assume that the growth of earnings is capped to be less than the growth of the overall economy, which is going to be approximated by using the risk-free rate of return. Well, knowing that relationship, we really only have 2 values to deal with now, cost of equity and reinvestment rate, because the future return on equity, we can determine it knowing the risk-free rate And knowing the reinvestment rate, we know the future return on equity. So we're only dealing with two factors in this scenario. Now, before going into the spreadsheet to show how to handle this scenario, I want to point out that Dr. Damodaran suggests one way to handle this scenario is just increase the mean reverted future PE by 10%. That is similar to a slight increase of return on equity over the cost of equity. So let's go to the spreadsheet and see what we're talking about. Up here, where you're earning a price earning multiple, currently for Walmart, 17.8, 10% would add about 2 to it. So I'm just going to take it up to around 20. Now notice increasing the PE to 20 means that the return on equity is greater than the cost of equity. And the earnings is now, we're forecasting a 4.4% earnings in the terminal value period. Now, we haven't talked much about comparisons up here, but one comparison is the risk-free rate. So the economy is going to grow at about 2.5%, but with a PE multiple of 20, we're assuming that we're going to be able to make 4.4% in an economy that's growing at 2.5%. Now, the reason why the growth is so large is that it earlier had set the reinvestment rate to 70% for Walmart. So what we're going to do is set it back to the default of only 33%. And now that lowers the growth, which lowers earnings growth to a more reasonable number. Now, instead of using Dr. Damodaran's suggestion of just upping the PE by 10% and then changing these values to have a reasonable interpretation of what that increased PE multiple means, the other way is just to start with the input values first. So first off is the cost of equity. We've already been through how you think that through. So let's say we end up going with, for Walmart, a 5% cost of equity. Then you would consider what's the appropriate reinvestment rate to use. And look at the historical reinvestment rate, default. I'm just going to go ahead and just put in 50%. Well, now I go over here and I look at the future PE multiple. It's just using the default PE. So I want to go with a little higher PE. Let's say maybe 25 makes sense. Well, when I come over here and look at the earnings growth that implies compared to what I'm trying to keep it capped under of 2.5%, I need to back off this PE down to, let's say, 22. And I just keep looking here. I'm at 2.6, but I want to get under 2.5. So now I finally lower it down to 21. And then, yes, I get it right on with the cap value. A future PE of 21, reinvestment rate of 50, and a cost of equity of 5%, resulting in a valuation of $138.01. Let's now move on to the third scenario, which is uncapped growth, where we assume the future return on equities is much greater than the cost of equity. Now, I want to stress that this is for just a handful of companies, maybe a Tesla, Amazon, possibly Microsoft. But very few companies would warrant this kind of consideration. And before diving into this scenario, you should consider whether you should just extend the stage 1 period. So let's go back and look at that again. So instead of capping off stage 1 and then thinking that something unique is going to go on forever, just have this unique condition go on longer and then eventually drop down to a more mean reverted type future scenario. Well, the approach we're going to use is similar to what we did for cap growth. The main difference shown here is we're going to check to see if we've gone beyond some reasonable limit. We're going to use the K factor, which indicates how different the assumed future return on equity is for the cost of equity. And as a general rule, we're going to use 1.5 times the cost of equity as an upper limit. But this is a soft limit, as opposed to the hard limit we used in the capped scenario. So this is an example of an uncapped scenario using Microsoft instead of Walmart. Start off over here and think through the future cost of equity. I'm just going to go with 9%. Reinvestment rate, I'm going to go with 60%. Then I'm going to go over here and compare the current future ROE I've got compared to this capped ROE of 13.5, which is 1.5 times the cost of equity of 9%. So I'm under that. You can see that clearly over here in the K factor of 1.12. And again, we're trying to keep that under 1.5. And I'm going to come over to here to the future PE and enter in a value something greater than the default of 14.8. I'm going to go with like 20. Well, I see what impact that has on the future return on equity, and it's still below the 13.5%. So I'm going to up it to like 25, and it's still below, but I'm going to stop there. Well, the K factor is 1.34, which is below the maximum that we're trying to keep it under 1.5, but that's still a return of equity that's over 33% larger than the cost of equity, and that is something that's being planned on to go on forever. So that's a pretty high future return of equity. And I notice here that I've come up with a valuation of $288.17 versus a price of $235. So that's essentially the exercise. Start off here and then enter a future PE value that results in a K factor of less than 1.5, which will cause the future return on equity to approach the capped future return on equity that you're comparing it to. Next, going to talk about doing some sanity checks on this future return on equity. We've already talked about two of them in the context of capped and uncapped scenarios, but also you should use these other values to do a comparison, maybe some historical or past ROE numbers, and then some that are more future looking. Now, let's look at some past ROE numbers. One is based on a sales to equity ratio, and I won't go through it here, and the other one is just the historical accounting ROE. Another approach that you might think would be used would just simply calculate the trending of earnings, and divide that trend of earnings divided by a known reinvestment rate to end up with what historical ROE number was. But we don't use that because it's very difficult to measure historically what the reinvestment rate was. That reminds me of this comment by Bill Nygren, who said, analysis gets real fuzzy when it comes to how much capital will be needed, but I'll throw in there even was needed to support growth. And to show you, generally what's involved is that you can even, when you're determining historically what the reinvestment rate was, you can do it either in an internal view or you can do an external view. Internal view is take the net income, you look up depreciation, add it back, subtract off what appears to be new investment, and subtract off inventory changes, receivables changes, payable changes. There's just a lot of things that goes on there and a lot of things to get wrong. Another approach is take an external view and just says, well, I'm just going to look at dividends and net repurchases. That's a little more straightforward, but still fairly easy to mess up, so I don't recommend using it either as a way to compare your future return on equity with some historical number. All right, so just to make sure you know where to find these comparison values out in the spreadsheet, they're all located here and broken up into the two backward looking that are more just historical in nature, and then we've got the two that were used in the capped and uncapped scenarios, and then you got these two here that allow you to read the notes on them. They're all just meant to be different ways of comparing the actual future ROE that you've computed in along with the implied future earnings growth. Since this video was originally recorded, some information that deals primarily with the amount of debt used by a company has been added. This has already been discussed in detail from the 22 to 29 minute mark. At a minimum, it is suggested you rewatch from the 24, 30 to 26 minute mark. So what we're going to do next is an additional sanity check on the target return on equity in light of the debt being carried by a company. And then we're going to explore the impact of different levels of debt on the return on equity. First, we're going to make some changes and revise this targeted future return on equity. I'm going to do that by changing the assumed price to earnings multiple. I'm going to change it pretty significantly up to 22. What that does is it gets the value fairly close to the current price, but now we want to see if that's realistic at all. And you can see by making that price to earnings multiple change, that now changes the implied future return on equity to be 12%. So with a future PE multiple of 22, we have a future ROE of 12%. Well, if we look at this part, we see that a 12% ROE would require a pretty substantial return on equity above the cost of equity. So here we are with a cost of equity of 5.8%, but at 12% we're even beyond what's shown in this table. Now that is in the realm of possibility for a company like Microsoft, but you are pushing the limits to think that even Microsoft can make a more than double the cost of equity into perpetuity. Now I do want to demonstrate that for other companies that have higher loads of debt, Microsoft only has 2.7% debt to the market value of all invested capital, namely bonds and stock. But for other companies that have a higher ratio, you can see here that if I were to put in, let's say 40%, you start getting into some pretty high possible ROEs just because of leverage. If I take it all up to 80, yeah, you could see some companies that could more realistically with leverage be able to have very high returns on equity. Well, now that we've been through the use of the spreadsheet, let's do a quick review here. We compared the spreadsheet to the Polaris Investing website and identified that there was 3 sliders on the website, and those same 3 values can be entered in the spreadsheet. And they are the most significant factors that go into the valuation formula. The spreadsheet goes further and provides input to the other values that go into the valuation formula. What we learned by going through the worksheet is that the valuation, which here shows $118.44 for Walmart, is pretty sensitive to these few significant inputs. For instance, this went up to 129. I clear that, and now we move down to the profit margin. If I go from 2.3% to 4%, it jumps to 200. And now if I go to the PE, the future PE, and change it to something like 20, you see it jump as well. So very few significant input values, but changing these values demonstrates how sensitive the valuation formula is to its inputs. This sensitivity is not unique to this formula. It's something that's been observed for quite some time. Here's a comment from Burton Malkiel. It says there is an inherent indetermination in valuation. Another quote here from Curtis Jensen, Third Avenue Management Hedge Fund. He said, discounted cash flow is like looking through the Hubble telescope. Move it a bit and you end up looking at an entirely different galaxy. Well, recall the valuation formula used by Polaris is a 2-stage valuation model. And we showed, that we assume that there's some near-term cash flows followed by a more normal period that is in the terminal value. And the way that analysts typically try to work with that is they, as we showed before, do try to do year by year explicit cash flow forecasts. But they end up with the final year of near term some number that's fed into a terminal value multiple. On the Polaris valuation formula, that final cash flow is pretty much determined by the current sales, the growth of sales, the future profit margin, and the terminal value factor is the future PE. That's pretty much these 3 values: growth of sales, profit margin, and the terminal value or future PE multiple. Well, when you have a model that has few inputs, those inputs are going to have a big impact on the output of the formula. There are other formulas that do discounted cash flow. For example, this one is available from a website called Value Pro, but there's 20 different inputs into this formula, and it's questionable whether that increased number of inputs really adds more insight and accuracy to the resulting valuation. There's lots of other sites out there. We just mentioned Value Pro, but there's one here called Simply Wall Street that does a good job of showing you the details of how they calculate their valuation. But there's just this trade-off between lots of input values versus few, and then the sensitivity that you have with each input. So as we wrap things up for this video, I'd like to leave you with some things to consider around financial models. Models are really best just to be thought of as tools to help you explore, to really give you a framework to help you make difficult decisions under uncertainty. Models allow you to take foundations for granted and not be overwhelmed by the complexity. But at the same time, it also gives the user an opportunity to make mistakes by forgetting assumptions that are made in the model that need to be considered. So the best financial models are ones that make few assumptions and have a small number of inputs. The inputs isolate and limit contamination between them, have very considered orthogonal type inputs that are fairly unrelated to each other. Best models use straightforward math because complex models rarely improve results. And also best models have a limited scope and apply simple theories. All right, going to wrap up with this quote from the character Salieri to Mozart in the movie Amadeus. You make too many demands on the royal ear. There are simply too many notes. Well, thanks for watching.